So before we kick this off today, I want to just share that everything we talk about is for educational purposes only. We're not making any recommendations here to buy or sell any particular securities. We are a little bit alarmed by what we see in the marketplace and just in the world in general. And so we want to kind of walk you through what we see as some challenge areas that also could lead to opportunities. So I'm going to try to make this PowerPoint advance. All right, so these are some things that are very, very pressing. We just took a few of the main things that we see out there that are problematic and put them up here on the screen. 1 month, COVID cases in the US went from 44,000 with 550 deaths to 878,000 with 49,000 deaths. So that's becoming much more of a problem to the markets and the economy and our culture. No shortage of oil. Oil is so abundant because no one's using it that oil prices dropped 70% already this year. That's a pretty spectacular fall in the energy world. No interest. Federal Reserve has emergency decree that interest rates will be 0 for the first time ever. Wow factor, CARES Act passed, put us into a deficit for this year, projected to be $2.6 trillion annual deficit this year. Lose a job, lose health insurance. 39% of adult Americans surveyed the first week of April either lost their job or had reduction in hours, temporary leave. Basically half of the population in the US has access to health insurance through their employer. And so we know that there's some problems coming on the medical insurance front. Indecision, volatility in stock markets more than triple that it was last year. And so that's pretty substantial increase. Those are a few. Wipeout, last 6 weeks, over 25 million jobs have been lost. Now, you know, that's an astonishing number. That represents all of the jobs that have been created since 1998 have been lost in the last 6 weeks.
Hey, Lynn, this is Brett.
Hey, Brett.
Just to add something to that, and that was before today, which, you know, this last week was another 3.8 million jobs. And if you do the math, right, just to put this in a little bit of perspective, we basically were starting with 3.5% unemployment prior to the crisis or the virus. We've now lost approximately 30 million jobs, which out of 155 million basically U.S. workers adds up to about 20% of the workforce. So if you add the 3.5 to the 20%, that's 23.5% unemployment. Is kind of what we're looking at a snapshot right now. Now we know that some of that will probably come back rather quickly, but just to put that in perspective, back during the Great Depression, unemployment peaked at about 25%. And then back in 08 and 09, we lost about 9 million jobs during that cycle versus, you know, basically 3 times that in 6 weeks. And when you have an economy that's driven 70% by consumption, that's alarming.
Yes, definitely. Which is, again, one of some pretty substantial things. 64% of commercial aircraft sitting in storage today. The end of an era. All of this difficult information coming out in the last few weeks. We've kind of glanced over this one, but Social Security. Trustees announced last week that the trust fund backing the payment of Social Security benefits will be at 0 in 2034. Last year, when they ran their analysis, it was 2040. If these jobs don't come back and nobody's paying into the Social Security Trust Fund, they might revise it next year or something even sooner than 2034. Now, that doesn't mean that starting 2034, people get no Social Security checks, but it does mean that the money to fund it would drop to 76% of what it's originally intended to go to and what's been promised. So basically, if you're my age, I'm going to be 50 next spring. If you're my age or younger, the writing's on the wall for Social Security. And then lastly here on these by the numbers bullets, presto, Fed's balance sheet reached 5.45 trillion, up from 3.85 trillion in February. $1.6 trillion of assets on their balance sheet in less than 2 months, resulting from the digital creation of money with the press of a button. And that was essentially them buying an enormous amount of assets to put on their balance sheets to hold the valuations of the assets up in the last 6 weeks. So these are substantial things. Other things, obviously, let's just talk quickly. I'm going to run you through some scenarios here with COVID-19. This is the screenshot from Johns Hopkins sort of control center and monitoring center. This chart was taken a little over a week ago, 4/20. At that point in time, the US had 784,000 cases, globally 2.4 million cases. The death globally at 169,000. If you just go 1 week forward, then, which is, I've just advanced the slide, you see now the cases 1 week later was at 3 million. The US is at 1 million, total deaths at 215. So this is essentially 1 week of time where the world economy, for the most part, has been shut down, right? Now, I am not a medical scientist. I'm not connected to the medical industry. I have no insights more than anybody on this call can read from the news. We do, listen to a lot of things and read a lot of things to try to be in the know as best we can. But if you just take the rate of the spread for this week, which represents a week in time where the world economy has had shutdown situations in effect for well over the 3-week incubation period, you're looking at a 30% per week increase in cases. And if you look at the total number of deaths relative to the number of cases, it's running between 5 and 6%, some places higher, some places lower. I just wanted to use a mathematical illustration to help us at least be prepared for, as best we possibly can, to understand what 30% per week with a 5% fatality rate might look like, does look like mathematically in the US alone. And this is alarming to think of it this way, but it's just, taking what we just experienced and forecasting it forward. Nothing different than a lot of the things that we do for our investments. This would show that, by the end of May, we would expect to see somewhere slightly under 3 million cases, with US testing positive, loss of life at, 140,000 individuals. By the end of June, maybe 8 million, and up in the 400,000 range. End of July, 23 million, over 1 million lost life, so on and so forth. Now, we've highlighted this gold box section because we know that there has been very positive information put forth on the treatment side of things. And we can't mention individual stocks and companies on a public call, but just this week, we've got a couple of companies that have had FDA, moving things forward through that believe that they would be able to provide treatment for a large quantity of these larger number of cases July and forward. So the fatality rate may not be to this degree if these treatments work. But this is based on a shutdown economy, and many states around the country are talking about reopening, and so that's pretty alarming. If you look at this data from Morningstar, and I'll tell you, this data from Morningstar was produced in the first week of April, so this is 30 days old, but they put a team of folks out to try to say, hey, how would this might play out in our economy? And they anticipated that April and May cases would be around 1.2 million new COVID cases. It hasn't been that much. In April, I think in the US, maybe 800,000, so they were off the mark there. But their thesis is that you'd have a lot of case count early, we'd shut down the economy, people would stay locked down, the scientists would go to work, find some cures and some treatments, and then they would reopen the economy in the summer, and then when we got back to the fall, we'd have a lot higher case count. They even projected like 12 million new cases in October and 18 million in November when the kids go back to school and they just spread it around in the school system. But at that point in time, their hypothesis and their base case assumption is that there would be treatments that would bring the number of fatalities down to something that would be similar to that of like the common flu, you know? So, but again, the case count and the projections all are based around how we social distance, how well the economy is shut down, and even when it reopens, how things trigger. Now, I will tell you, and we're going to move on, that these projections that we're showing you, and not only here from Morningstar, from just our basic numbers, I'm going to show you another one from DWS. They're very different than what you see being put forth in a lot of other places. I was looking at a website last night that's administered by a nonprofit that the government set up to monitor it. And a lot of those models say, hey, this will be in the rearview mirror by summer. So there's a lot of unknowns, but as investors, we have to be prepared for things that maybe aren't what public opinion might be, right? Now, this chart here that's up on the screen, this is where Morningstar took their data and said, okay, well, we believe this is what will be impacted from the economic standpoint. They think all large events will essentially have pressure to not happen. Greater than 75% of them will be canceled through the end of the year. And that includes things like college football and, you know, Major League Baseball and big sporting things that are very, very significant contributors to the economy. They do think schools will probably reopen in the fall. They think some restaurants and bars will reopen in non-essential businesses. So this was their early projections. How we behave will change, has changed permanently, maybe. Working from home, you know, they are of the assumption that 50% of the population will work from home. I was listening to another sort of futurist, very respected person that does some things in Washington recently said, hey, you know, in the US, if you're over 60, or if you're obese, or if you have heart disease, or if you have a whole other set of things, you won't return to the public workplace. It will just be too much of a risk unless there's a cure. So these numbers are sort of representative of the things in our economy that will remain in limbo or shut down. So pretty substantial forecast. So that is some pieces of information that just help us to kind of understand the severity of the COVID situation along with these other economic things. Switching gears, DWS, Deutsche Bank's group here that operates the investment side, they did a different analysis that helps us to get some projections around the stock market. They looked at the impact of a shutdown, the impact of an economic shutdown on earnings in the S&P 500. So when you look at this chart, the blue section is just saying, hey, in 2019, S&P earnings were $164 a share. That's what they made. If we had a national shutdown for 30 days, now they presented this data a couple of weeks ago, so I'm giving it to you a couple of weeks later. But if the shutdown had only gone through April 15th, they're showing the percent change in earnings by quarter that they think that the shutdown would have caused in the economy. What you'll see is a 30-day shutdown would reduce the 2020 earnings per share estimate down to 150. They think a 60-day shutdown would reduce it to 110. And you can kind of look quarter to quarter and see how the longer that the shutdown goes on, the less earnings are for each quarter because companies aren't, you know, doing business. So if you not knowing the degree of how long things will be shut down, we understand in certain places they're going to try to reopen this week or next week. But what we don't know is, will they try that in 2 weeks from now saying, hey, we have to shut it down again because the case count's rising too fast. If you took the average of this 30, 60, 90, and 120-day assumption and you said, okay, if you blend all that together, then you would have an earnings outlook for the S&P 500 for 2020 somewhere between $85 and $110 because we're already at the 60-day. We took the 30-day off. if you have S&P earnings outlook at 85 to 110, a lot of the forecasters and even DWS formally put their year-end targets for the S&P at 2750. That means the PE ratio, the price of the stock market relative to the earnings that it produces this year, would be around 28 times earnings. Now, I don't want to make this an overly technical call, but anybody that's been an investor for a long time would know we haven't seen a PE ratio on the S&P 500 at 28 times earnings until, basically the very top of the dot-com bubble before it bust back in 2000. So what's happening is that investors, if the market is selling at 2750, which by the way, it's higher than that right now, they are pricing in that this is a quick recovery and that we will be well beyond these earnings outlooks of $85 to $110 a share sooner than later. Now, I don't think anybody would have a whole lot of argument about, well, 2021 will be a recovery year and 2022 will be back to more normal in terms of earnings, but that's a very ambitious price for people to pay right now, what they're paying for stocks, if you're looking at the index as a whole. So this just helps you to realize that maybe the market has gotten a little ahead of itself if you look at the earnings potential of companies. One of the largest companies in the S&P 500 index yesterday announced that their earnings projection for the second quarter was down 50%. So that's just one of many contributing factors. So here's our takeaway, right? The drivers for the market for the rest of this year, things we have to be conscious of as we try to navigate investing in this process. The market is going to move based on the ability of companies to sustain their earnings, not just today, but we can already see that investors are paying for future earnings. They're looking beyond COVID-19 and saying, hey, I'm going to buy this company today because I think 2 years from now it'll be okay, right? There's no way in the world the market would be priced at what it's priced at right now if that wasn't what investors were looking at. So we have to think about, well, what are the things that happen that change that perception, So if the economy were to go back into shutdown and it resets everybody's perception of when things will be back to normal to a date further out, that's a very substantial, that would be a very substantial surprise to the market price at the moment. So volatility will be up because as projections about opening and reopening and shutting down all that change, volatility will be driven in both directions from those assumptions. And then for our investors, how do we as individuals process, well, what do I do with my money? We have competing objectives, right? There's investors that want to buy on the dips. I've probably gotten 10 emails this week. Did we miss our opportunity to buy at a discount? Because your understanding as investors is, I want to buy things low and I'll sell them when they're high. And we had some really crazy discounts a few weeks ago. But at the very same time, that same exact investor, in many cases, freaks out if they get their portfolio and they lost 25% of their money. So there's a lot of people that are conflicted about what to do at this moment. So I think for each of us, we have to decide for each bucket of money that we have the ability to influence, is this short-term money? Is this mid-term money? Is this long-term money? And with long-term money, we can, buy on the dips. We can take a little bit more of an aggressive approach. We can do some other things we'll talk about in a minute to take advantage of the volatility. But if it's money that you might need in 6 months, which, by the way, 3 weeks ago, you might not have known you were going to need it in 6 months. If your job has gone away or your income has been cut, what if it doesn't come back? What if it stays cut? You might need money in 6 months you didn't think you were going to need. So I think you have to really look at each bucket of money that you have and assess, can I really have this money invested for 5 years to take the gamble of buying on the dip and making something out of that? Or is this shorter term money and I need to be a little bit more conservative? And of course, we've got strategies either way, but that's an individual decision. And so make sure that you communicate with myself or Jason or Brett or John or whoever your advisor is. Hey, I want you to know my objective is I want to be aggressive with this money. I want to be conservative with this money. I think those kinds of conversations are really helpful right now. Jason, Brett, Justin, anybody want to chime in on any of that? Okay, well, we'll move on. I'm looking at.
Hey, now, this is Justin. I'll unmute myself, but there's a lot of different opinions, and the fact is that it's all fluid. We don't know. We don't pretend to know. We have to prepare for the worst and hope for the best. And I think that we're well positioned in portfolios and with each unique situation, each client situation, to do that. So just want to reiterate, we have no idea where the fatalities and some of the fear-driven stuff, and we've got to be real careful because you can already feel this thing being somewhat politicized, and we're in an election year, so there's a lot of moving pieces, but it is real. And when we get into some of the economic numbers, it's hard to fathom where we are with some of the economic numbers that we've already touched on in the market.
So the takeaway there is every person is going to have some tendencies that they want to be aggressive and take advantage of the dislocation in the market. And at the same time, most every person is going to have some degree of, man, I sure would like it if I don't have to lose any money right here. And so there's this natural born conflict embedded in how do we behave in the midst of this very uncertain moment in time that has a lot of negative red flags all over the place. So we'll keep moving. So this chart here is just from a couple weeks back, just showing you how steep the market fell, 34% from the peak earlier in the year, and it's made back a good chunk of that. I think it's tremendous that the market's only down 10%, give or take, or 11% year to date in the U.S. index relative to all of the horrific things that have happened and how much earnings have dropped off. But again, I think investors are paying extreme valuations because they're looking forward past this pandemic and saying, well, we think these companies will survive that. But I want to take you into a little detail about the S&P 500 because it is very misleading to most investors, right? This is a very funky chart. So this is a representation to illustrate to you that within the S&P 500, there are 5 stocks that basically are the equivalent market cap value as the bottom or the smaller 350 stocks. So these 5 companies on the right-hand side here, if they go up 10% tomorrow, 350 companies, S&P 500 companies, could also at the same time lose 10% and the S&P would not move at all. So when you get this kind of concentration into only 5 or fewer companies, you got to start asking yourself some questions. Now, we just sat around the office yesterday and we were talking about, hey, what's wrong with this chart, right? And just some of the things that we came up with is, well, first of all, these are all tech brands. So it would make sense that the money that's out there and the massive money that's been put into circulation is looking for a home, and investors want to buy stocks. And these 5 stocks seem to be, to some degree, less vulnerable to COVID-19 than others, although not entirely less vulnerable because, again, one of these companies yesterday announced outlook of being down 50% in earnings. But so one thing is, it's all technology. So what about all of the other sectors? There's blood in the streets, right? Another thing is that historically, when you see concentration into the very top stocks, this chart shows you sort of the other periods in the last, well, since 1965, that there's been high concentration into 1 or 2 brands. Now, I can't speak very well to what happened in the 65, 70, and 75 era. I know it was a really high inflation environment, and there was a lot of difficult things going on a regular basis back then. But we do know that in the early 80s, there was a concentration just prior to the lead up to the S&L crisis. In 2000, there was a concentration into a few main companies just before the tech crash. In 2007, 2008, there was a concentration just before the financial crisis. So when historically, in the last, at least since 1980s, every time we've seen this divergence or convergence into just a few brands that represented a ray of hope and light within the vast number of investment opportunities in the market, when it gets converged into these little teeny segments, that's generally been a precursor to some bad economics yet to follow. So that alarms us, that there's such concentration into those particular segments. So our general view in processing all of this information is that we are not out of the woods. If you were to go and look at the stock market, you'd say, well, it's almost back to, you know, where it was 4 months ago. Maybe we're closer to out of the woods than we thought. But that's not our view. Our view is that it's 5 companies that have gobbled up all of the investment capital and concentrated it and made it appear as if the market is okay, but it's not. And there's so many things that are very, very radically out of balance right now that we just think it's important for our clients to understand that, you know, we want to invest and make money for the long run. We think this will pass, and everything that we purchase in this period of time will be good for the long run, but this could have another leg down or 2 legs down. So we just need to be patient.
Hey, Lynn, this is Brett again. A couple of things to add about that. I think you're right. That's the main takeaway that we would like most of the clients to take away from this, is that, yes, it's been nice to have, you know, a rally in the market from basically the March 23rd bottom until now, but by no means is that, you know, signaling all clear and everything's fine and back to normal. I think one of the things you looked at, I know we can't mention specific stock names, but one of those on that chart, literally, like you said that their Q2 2020 earnings will be 50% less than their previous year Q2 earnings. And the market took that news and the stock was up about 8% the next day. All right. So that doesn't make a lot of sense. At the same time, we had a chart there that showed looking for a bottom. Well, I would just remind everybody that, and I'm not comparing this to 2008, 2009 necessarily, but even back in 2008, 2009, the market from peak to trough lost about 55%. There were 3 separate times where the market had rallies in that environment, 2 15% approximate rallies and another rally of approximately 20%. So you can get big rallies, pretty significant rallies in the midst of a bear market. So.
All right. So what do we do with this? I mean, how do we take this information and behave in such a way that is going to produce a positive outcome from an investment standpoint? I just wanted to touch this one more time, the win by not losing concept. You know, part of our investment process, we use trend analysis, not all of it, but in every account, we have some that we use trend analysis. And this is a graphic just showing you how visually that works. You know, back in March of 19, the market was moving above its trend, stayed there for a while. We were fully invested. Earlier this year, we started getting signals that things were shifting, so we began to sell parts of equities out of that trend strategy. And we literally were 100% out of the market in our trend strategy, you know, during the month of March. Things got so below average in terms of the price of the market below its 200-day moving average that we actually took 10% and re-entered at the beginning of April. But even in that, it was more of a, well, we did it with a structured product that had a floor on it. So, and we didn't do it in every portfolio, we did it in most. But our view is when things are moving into higher areas and everything is healthy and in a normal trading range, you want to participate there. I don't think that you want to just buy every dip. You know, we bought a little bit on a 20% below 200-day moving average opportunity because that was pretty extreme. We probably will get some more dips in this to try to buy some more pieces of equity. I think this chart here maybe can help you to understand the value of saying, okay, I'm going to sit out and miss some of the heavy, very bad days, even if it means I'm going to miss some of the good days. Now, since 1985 to now, this chart is showing us that if you missed the best, I'll start on the bottom. If you missed the best 25 days, you just had the worst luck in the history of time, and you got out of the market the day before the best 25 days for the last, 35 years. You'd have turned $1,000 into $7,400. The blue line, the second one up, is if you just bought and hold. I'm going to buy the S&P 500. I'm going to own it no matter what. You'd have turned $1,000 into $36,000. The purple line is where I think it's important to pay attention. If you missed the worst 25 days and you missed the best 25 days, and in this period of time, 90%, approximately 90% of the best 25 days and the worst 25 days took place when the market was under its 200-day moving average, which is very much a barometer for our trend process. Then the purple line represents more of what your outcome would have been. And what this illustrates is $1,000 turned into $46,000 versus just turning into $36,000 is it illustrates to us that you don't have to be in the best days if you just miss the worst days. And I don't think people fully grasp that, but it's the math. If you lose 30%, you have to make 45 or 50% to get back to whole. If you lose 50%, you have to make 100% to get back to whole. So, we lost, the market had some big, giant -8, -3 weeks. And then we've had some weeks that are +3, +8. You're not back to where you started. And then, of course, the green line is if you're living in off a crystal ball and you've long retired because you just got out and missed the bad days only, which is impractical. Nobody can really accomplish that. But trend work helps you to realize you don't have to be in for all the best days if you prioritize missing the worst days. Okay. And of course, the correlation is most of the worst days in the history of the market have come when the market's under its 200-day moving average when there's heightened volatility. So with that, what do we do? How do we behave? What kinds of questions do we have? Before we open up for questions, I want to just mention a couple little things. Dollar cost averaging right here is probably the best weapon anybody has. This thing is, in our opinion, will be a historical event 5 years from now. And between today and 5 years from now, we're going to look back and we're going to have seen a lot of choppiness. And if we've got somebody plugging away each month and putting a little bit more money in every month, there's going to be some chop in there that allows you to buy more shares on the cheap. I think that's a very powerful weapon. So in your 401k plans, in your brokerage accounts, after-tax money, if you have dollars that you can invest systematically with a vision that you're going to leave that money alone for 3 to 5 years, that is where you will probably find will be one of the strongest investment opportunities you can make of this. Buying on the dips. If you're looking at the S&P 500 and you're looking at the index, you might not see the dip. Meaning, those 5 companies are capturing all this cash. And so it's not reflective of what the market and the economy is really doing. You can decide right now, I'm going to go buy the companies from number 200 to 300, and I'm going to just go buy, something that would represent that mix of companies. You'd be buying right now at a 25% discount, maybe a 35% discount, certain brands. So it's tricky to know when you're buying on the dips if you're just looking at the index, which is really just giving you the valuation that's very heavily weighted on the 4 or 5, shooting stars that are holding on. So you could try to buy the dips, but you need to be tactical and look at the things that are really dipping, not just the things that are in the index. And then I think you need to dollar cost average. And then the third thing would be communicate with us. Hey, this money needs to be more conservative. This money, I want to take a more longer term approach. We do that on a regular basis, but we need to know that, we need to reiterate that right now. So we know, because our more aggressive portfolios, we're probably going to do some things that are more aggressive here in the next few months to try to make something good out of what the market gives us. And our more conservative portfolios, we're probably going to be more conservative than normal because there's a lot of things to be concerned about. So there's going to be a divergence in what we're doing between our conservative stuff and our aggressive stuff. And we need to make sure we're in sync with our clients about where do you stand on each bucket of money. Okay, we've got a question. The question is, I think the disconnect between the market and reality is all the Fed pumping money. That is what is different between now and pre-2008. And that has to be taken into account. So that's not a question as much as it is a comment. And I do think that is very different, that the market is being propelled, at least at the index level, by all of the money that the Fed is pumping in behind the scenes. So if anyone has questions, this is a great time to put them in there. And we're going to try to make ourselves available here for at least a few minutes to ask or answer any other questions.
And this is Jason. On that question or comment about the Fed, one thing that I think is interesting, the amount of money they pumped in is equal to the amount of GDP loss if you calculate it dollar for dollar. Mm-hmm. So at this point, it's a wash. So right. They've thrown in all the liquidity. So you've backstopped everything and you've got the bounce. I don't know how long that bounce lasts because the economic numbers are going to continue to fall. So the GDP loss is going to be greater and greater. So the Fed, to stay even, is going to have to do more and more and more.
Yeah.
It's going to be hard to keep up for the GDP loss on a dollar for dollar stimulus basis.
And then that brings a question of like, well, what happens if we have another giant shutdown in 3 weeks? You know, can they do it again? And can they do it again after that?
I think also, this is Brett, that, you know, I agree with that comment that the Fed pumping all this money is a huge part of why the market has bounced back. But, you know, at some point, I mean, can the Fed continuously bail out everybody in every industry, every corporation? At some point, that doesn't equate to consumers feeling confident or having the money to go back and resume their previous spending, right? And that goes back to my point about unemployment earlier, right? If the economy is still driven by 70% consumption, and the Fed pumping liquidity in the market is not going to make consumers, you know, go out and spend a lot of money. I mean, that was the consumer confidence from March to April had the biggest drop in the history of that metric. So I agree that it's helping and it's part of the rally, but that doesn't fix everything.
So we have another good question here. Well thought. Is it possible to pick industry winners and losers going forward in the post-pandemic world, even though stock gains have been driven by the technology firms on the chart? Isn't it also true that in a world with less social interaction, those companies may be positioned to take advantage of that over the next decade? And I think that's a very valid point. I think that's one of the reasons it's easy for people to feel okay about indexing, because, you know, you look at those 5 companies and there's a few other companies that aren't in those top 5 that also have made very good short-term things happen. I mean, every time I try to go to Lowe's and I can't find a parking spot, you know, I'm thinking, should have bought some of this company's stock a few weeks ago. But here's the problem. As I said, and as we talked about, at least one of those 5 companies has reported earnings this quarter, you know, within just a couple of days. And they're saying, hey, our earnings forecast is down 50%. So for their stock to have essentially gone up or maintained its level, and the projection for their earnings has lost half their value, the actual value to the investor is now cut in half. You know, you're buying the future claim of earnings, and now they're saying our earnings are down 50%. So in theory, I think we could look at it and say, man, this is a company that can endure this, because they don't need to have social interaction, but at the same time, it's being sold at a crazy premium right now because the money in the market's trying to find somewhere to hide. So there are other companies that would be better positioned. If it were me, I would look at some of the companies that have done well, or at least have been able to maintain their business operations without too much disruption, that maybe aren't as glamorized, that don't have price to earnings ratios that are impossible. This is a question I've gotten a lot recently too. Brett, I don't know if you've seen it or Dustin, but a question around, with all the trillions of feds pumping into the market, what's the outlook for inflation and the impact of that? And my answer, you guys feel free to chime in though, is that I don't think you get inflation until you have capacity constraints on the economy. When the economy overheats, prices go up because demand is greater than the supply of goods and services. That forces prices up. It is historical, and I know, like when I was in college, you were taught, well, lower interest rates, pumping money in the economy is an inflationary force, but you don't actually see the outcome of that inflation until the economy is at full employment and full capacity. And I mean, we're nowhere near that. So it's almost like pushing on a string. I mean, you're applying force, you're pumping money into a system, but until you get all the way to some resistance, I don't think you run into any inflation issue. Do you guys have any thoughts on that, different than that?
No, I mean, I think it's logical to, this is Brett, I think it's logical that, pumping in money should cause inflation, but two things, right? Like you said, going back to economics days in college, there's a thing called the Phillips curve, which basically says that you can't have, or it's very hard to have high unemployment and high inflation at the same time, which is what we're staring at right now. And then the other thing is oil. The price of oil impacts inflation probably more than any other thing. And with the oil is literally down 70% or so from its high. So with those two things, it's hard to see inflation becoming a factor. I think deflation is actually more likely over the near term.
All right. Yeah, this is Justin. I would agree. I mean, you guys nailed it on the kind of the econ side. It's a supply and a demand thing, and it's starting to incorporate the velocity of money. And until there's spending, you can pump all the money, but until there's increased demand, it's hard to see the impact of that.
Well, hey, just being conscious of time, we're around 45 minutes in, so we're going to kind of bring this to conclusion. But we do want to encourage everybody to, be in contact. Let us know how you feel about different things that you've got. We want to make sure to execute a strategy that's in alignment with where you are feeling that you want to be risk reward. If you want to be conservative, you want to be aggressive, whatnot. And for most of our clients who've been with us for a long time, this isn't our first rodeo. We've been through some pretty crazy stuff, so we kind of know. But in these very trying times, people do have the tendency to change what their priorities are. So just stay connected with us. Let us know there. Some conclusions in our space is that I think being patient here is a very valuable tool. We've all made a lot of money over the last 10 or 15 years relative to, say, the bank. Even our most conservative clients have probably doubled what you'd make in a CD or whatever, and our aggressive investors have had 12 years of a bull market, and they've participated. So for the last 10 or 15 years, we've done pretty well. If we have to sit out a year or even two and just be in sort of this protection mindset, and then once things normalize, resume our journey, that's not going to be a terrible outcome. At this moment, we haven't lost a bunch of money for anybody. Our most aggressive clients, probably down 11 at this point. That's it could be way worse. So be patient. And then if you do have buckets of money that you're trying to invest more aggressively or buy the dips, you don't have to do it right this minute. There's always, the market's going to always give us opportunities. And there's so many red flags going on that it makes us believe that there's probably some more difficulty in front of us, especially if the COVID numbers that we are seeing from the financial analysts come out and are in line with what happens versus what I don't know what the general public is looking at, but I think people think that we're almost done with this, and not even 2% of our population have been impacted by it yet. So there's a disconnect. So be patient. Second takeaway is we don't have to buy a bunch of stuff at or near the bottom to have already won. Just by not having lost big dollars in the decline, that's 2/3 the battle, right? So remember the chart. You missed the best and the worst 25 days. You've done better than if you'd have just sat there and rode the roller coaster. And then lastly, and everybody can do this, even though you might even be retired, you can still do this. Find $50 a month, find $100 a month, find something that you've had that you're not planning on using for a while and say, let's put in a little bit every month for the next 6 months. I mean, dollar cost average something into some investments during this next 6 to 12 months. It'd be very difficult to imagine in a post-COVID world that whatever dollar cost average in this period of time didn't turn out to be a good thing. It'd be very difficult to just mathematically conceive how that wouldn't play out well. Obviously, there's no guarantees of future results, and all the compliance in the world will tell you that no strategy is perfectly safe, but it's a very powerful weapon when there's high volatility. So those would be the 3 things that we would encourage you to consider. Guys, you want to add anything else?
I would say just make sure you have your rainy day savings bucket full, and don't dollar cost average out where you pull your rainy day savings bucket down. Because no one knows how long this is going to last, and we're seeing furloughs in industries that you wouldn't think be affected right now. So make sure that's where it needs to be first.
All right, gang, if you have additional questions or want to follow up with us, we'll be around. We're not going anywhere. You can call or email. I need to run through the required disclosures as we wrap up. These are the views of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 Index is an unmanaged index representing the largest 500 companies in the U.S. Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation, fees, and expenses associated with investing. Past performance does not guarantee future results. All investing involves risk, including the potential loss of principal. There's no assurance that any investment strategy will be successful. Thank you for joining us today.